Hi everyone, welcome to episode 6 of season 4 of the Burges Salmon Pensions Pod. I'm Helen and I'm joined today with Chris. Hi Chris.
Hi Helen, hi everyone.
And today we're going to be having a discussion about insurer due diligence with Richard Hall, a partner at Argyll Covenant Advisory. Richard, thanks for joining us today.
Oh, pleased to be here. Thank you.
Richard, if I could start by asking you, what is an insurer due diligence assessment? And if you can explain that in a high level to our listeners.
Yeah, sure. You'll be aware that the pensions insurance market has sort of exploded over the last 12, 24 months, boosted in particular by the yields over 2022. So many schemes are in a position of being able to buy out where they weren't sort of planning to do just yet. So I think what's happening is you're seeing a lot of trustees and employers suddenly think, well, what is the strength of the financial or the strength of the insurer behind these transactions? So they're just doing a bit of due diligence around the financial strength of those insurers to sort of help, if you like, with the governance of the transaction.
Yeah, fantastic. Richard, I've been really looking forward to this episode because it's so topical, as you say, because the market has absolutely exploded, and sort of, those considerations that trustees have to take into account. I think this is going to be a really interesting episode for our listeners. So I suppose the question, maybe perhaps the $1 million question is, insurers are regulated, aren't they? So I suppose someone might ask, why do trustees need an independent assessment?
Yeah, we do get asked that quite a bit, and you're absolutely right. Insurers are regulated, of course, but I wonder how many trustee boards and how many employers actually understand the nature of that regulation, or in particular the protections that it offers and the limitations of those protections. So, just as a sort of a high-level view, the way it works is you treat the insurer a bit like a pension scheme. So it's got assets and liabilities as much as a pension scheme has, and then you hold a margin on top just to reflect the contingencies that it might face. And the margin is supposed to be sufficient to cover 99.5% of eventualities. So only the 1 in 200 extreme events are the ones not covered by that margin. That all said, all the insurers in the marketplace at the moment, and there are 9 currently, and we can see a couple more on the horizon, but all those 9, they use different models to get to that solvency margin, and they're invested differently. So you're not necessarily comparing apples with apples. So what we do is we go back to grassroots, we go back to first principles, and we say, well, look, what are the risks facing this insurer? And we look underneath, the investments and the use of reinsurance and so forth, and then we just put an overall measure of financial strength and give trustees the comfort that the insurer is good for the transaction, if you like.
And the reinsurance is interesting, isn't it? Because different schemes, different trustee boards of different schemes will have different approaches to assessing risk. But I've certainly been in trustee meetings where some trustees have put a lot of stall by whether the insurer is a household name, for example. But of course, that is ignoring the fact that there's a lot of reinsurance behind the scenes, and you might think you're dealing with a household name, and you are, but then actually, are you understanding the risks of reinsurance behind that?
No, I think that's absolutely right. And you're right, it has made the press quite a bit. So reinsurance should be a good thing, I think, for insurers, because it allows them to diversify the risk. So if you think over 2023, there were a couple of very big transactions. You had RSA 6.5 billion at the start of the year, and the big boots 5 billion at the end of the year. So it's better for insurers if they can spread that risk around. So that should be a good thing. But you're right. It does make trustees wonder whether they're really dealing with the insurer in hand, or whether they're dealing with the reinsurer, particularly if that insurer is ceding a large amount of premiums. So the reinsurer might be invested in a different territory, or might be based in a different territory. It might be under a different system of regulation, have a different financial strength. So again, it is crucial to understand exactly the additional risk, if you like, the financial standing of the reinsurers behind the insurer's proposition, and that forms a fundamental part of the analysis and enables trustees to get comfortable.
Yeah,
and
absolutely.
Richard, I guess
go on, Helen.
This is all to further trustees' understanding. It might be worth us just being upfront about what the legal duties of trustees are when considering whether to enter into a buy-in or buy-out with an insurer. So at its core, the decision to buy in is an investment decision for the trustees. And definitely most of my clients would engage with the employer, but actually it's more of a trustee decision. So they really do need to look at their rules and see if it's permitted, check that the investment's in accordance with the statement of investment principles for their scheme, and make sure that they're really taking proper advice in relation to this, both legal advice and investment advice. And I guess your due diligence advice can definitely come into that.
No, absolutely. I think that's a very sensible approach. I mean, to us, it just seems like it's like no other or like any other sort of appointment that trustees might make. So as you say, they might appoint legal advisors, investment advisors, covenant advisors in the ordinary course of things, for which you go through a due diligence process. It would form part of the trustees' governance processes. It shouldn't be any different really for selecting an insurer, because the difference with an insurer and selecting the other advisor is if things go wrong with the other advisor, you can just appoint another advisor and that's it. You just carry on as normal. But you really have one opportunity to assess an insurer, so it does make sense to sort of kick the tires a bit.
And it's a very high duty of care, I was going to say, with investment decisions by trustees. So the classic case is Re Whiteley, where the care is that an ordinary prudent man would take if he were indeed to make an investment for the benefit of other people for whom he felt morally bound to provide. So it's such a significant decision. It does make sense to try and get all the information you can about who to choose.
No, it really does. And of course, we're talking trustees, but actually the same concern should apply to employers. And I think in our experience, this sort of transaction does tend to be done very closely between trustees and employers rather than one or the other, partly because often there's a cheque to be written at the end of the day by the employer. So, to fill that perhaps small funding gap now to get to full buyout may need a bit of funding from the employer, but it tends to be done between trustees and employers. But their concerns should be the same. They don't want to find that their transaction and their decision-making process is picked over at the end of the day, and they want to be able to demonstrate that they've done enough due diligence.
Yeah, absolutely. So forms a very key part of trustees and trustees' duties, and as you say, same concern for employers. What about sort of, if trustees are lucky enough to get more than the one quote, does sort of thinking about due diligence on the insurer help with sort of other situations as well?
Absolutely. So particularly in those situations when trustees are lucky enough to have more than one quotation, and those do tend to be some lucky situations. Often some of the situations we see, there's only one insurer that's prepared to quote. But let's say you have got more than one quotation, then a financial strength assessment might help trustees steer between one insurer or the other, particularly if pricing and everything else, as everything else might be the same. So it can certainly help then. And I think also when you've got a situation where trustees are interested in the change in covenant. So they've got a covenant now which might be perfectly reasonable from their corporate sponsor. What is the covenant going to move to if they move to an insurer? And again, those sort of situations we're increasingly seeing.
And that's not always a straightforward decision. If you are sponsored by an employer which for different reasons might have a very, very strong covenant, perhaps on par with insurers, and actually that level of analysis there can be really helpful.
I think that's exactly right. And we try and bring out sort of the salient points, if you like, that trustees should consider in that transaction. I mean, particularly with any corporate versus an insurer, you have got the sort of, if you like, ongoing comfort with an insurer that they're going to be regulated on an ongoing basis, whereas often with the sponsor, there's no ongoing regulation or sort of constraints in terms of how they operate. So, it can be, it can sort of help in those situations also.
And Richard, definitely when we're producing kind of the final advice to trustees about whether they should do the no-go decision on an insurer, we always cover about the financial services compensation scheme. Could you provide just a bit more background to that and how that supports these kind of transactions?
Yes, well, all bulk purchase annuities, all sort of buy-in and buy-out transactions, the benefits are covered by the FSCS. I suppose there has been a little bit of concern in the insurance industry whether the FSCS would pay out in the event of collapse of one of these large BPA insurers. So there is that sort of concern. I think also, to use a covenant analogy, within the sort of within TPR's risk framework for sort of schemes or trustees assessing sort of the risk management of their schemes, the guidance is that you probably shouldn't rely on the safety net of the PPF when you're sort of looking at risk in schemes. You should manage those risks.
ITS and hope.
Exactly, in the sort of with the sort of premise that safety net isn't there. So again, it perhaps steers more into a case of the trustees ought to do their own due diligence rather than rely on the comfort of the safety net, assuming it's going to be available.
Yeah, okay, so that's really interesting. So Richard, we had another question for you, which is, can you tell us about some of the key differences between the insurers, please?
Well, one of the things you notice most frequently is actually there are only sort of a few of them that are famous names. Really, less than half are names that you might have your car insurance with, or house or life insurance, whatever it happens to be. So while we'd absolutely stress, covering off your point earlier, Chris, that probably familiarity isn't the only thing you want to be looking at in terms of financial due diligence, it does nonetheless create a bit of uncertainty on the part of trustees and employers. How good is this insurer for the money if we haven't even heard of them? So again, it sort of steers perhaps towards some independent expert help there.
They're all invested differently, I suppose, as well, aren't they? And different exposure to different types of assets, perhaps?
They are indeed. They're all invested differently in addition as well. So you'll find that a bit like a pension scheme, they're invested, you won't be surprised, in a variety of fixed interest, so bonds and so forth. But all those portfolios of fixed interest securities can have different and do have different credit strengths. So that can vary quite a lot between insurers. And also insurers tend to get invested in more sort of interesting things than sort of plain vanilla equities and bonds. So they're invested in infrastructure and in particular lifetime mortgages, and all that can vary between insurer, as can the use of reinsurance, as we touched on earlier. So again, these are all things that trustees need to understand.
Is there a problem with lifetime mortgages? You do see a lot about it in the press, and perhaps some uncertainty for trustees when they acknowledge that those are part of the portfolio.
There's not a problem per se. I mean, they're just an investment category that all the 9 insurers are exposed to. So a lifetime mortgage or an equity release mortgage is just where a policyholder effectively releases the equity in their home through a loan. So they get the proceeds of the loan against their property, and they use it to spend on cruises or whatever else they happen to do in retirement. And then when the policyholder dies, the property value is used to repay the loan to the insurer. Now, that's fine, but as long as the property value is sufficient to cover the loan plus interest at the point of death. And obviously at the moment in the UK property market, things are sort of heading south a bit. Property values are falling. It becomes crucial to understand what the exposure of the insurer is to the sort of fall in property values, and understanding what their sort of LTM portfolio is all about. So again, a crucial part of the analysis. But as I say, they are all exposed to it. So it's just a category of investment that is quite common among these insurers. The other thing to bear in mind is they get a sort of what's called a matching adjustment credit for the LTMs. So what they do is they parcel all these mortgages up into securitizations, and they get additional credit for it when they're valuing their liabilities. So it puts a lower value on the liabilities and a lower value on the capital requirement at the end of the day. Now we know, as part of the proposed changes to Solvency II, this is an area, the matching adjustment is something that will be looked at. So again, if the insurer is very exposed to the matching adjustment and has a big reliance on it, it could mean that they have that things could change if there's changes made to the matching adjustment. So again, it's something that we pay close attention to.
Yeah, absolutely. And I think what certainly I'm getting from this conversation is that I think we're probably only really scratching the surface of descriptions there of assets that different insurers hold and the sorts of things that covenant due diligence would look at. And it's a fair question. Do trustees fully understand all of this when they're signing over, all or the large, a large proportion of their scheme's assets to the insurers in a one-time decision? So, really interesting. What sort of things would you expect an assessment to contain? Sort of could you summarize the sort of like different sort of topics or what an assessment might look like?
Sure, and absolutely. I mean, the main thing to understand really with the financial strength of an assessment of an insurer is actually its balance sheet. So it's a bit of a change from a covenant assessment that you might be used to in the ordinary running of your scheme, where you're looking at profit and cash flow. We do look at that a bit, but actually, to be honest, the thing that's most of importance is the balance sheet. So we'd look at sort of solvency capital requirements, you look at what they're invested in, you look at the use of reinsurance and so forth. We'd also want to understand the legal structure, just understanding which entity you're dealing with, particularly if you're part of a larger corporate group. So that's very important as well. And also a peer analysis, just looking at what the other insurers look like in the group, and so you can understand where the chosen insurer actually fits in within their peer group. And
would that be something you envisage for clients who only have one quote or only dealing with one insurer as well, because even if you haven't got a choice to select from, I suppose that really helps you with your decision that yes, this is the only insurer and I'm on a exclusive basis to get the quote from them, but actually, to give me comfort that this is still an appropriate move, vis-a-vis the others in the market that I could have been speaking with.
Yeah, exactly that. So I think it just provides the next level of comfort, because people, it's human nature to want to know where you sort of peg against the other insurers.
Yeah.
So I think it just helps knowing where you sit on that spectrum.
And I guess trustees, this is such a significant part of it for trustees to consider, but they will, depending on the size of the scheme, have other considerations, for example, ESG, how the members are going to experience the new insurer and things like that. But this is the financial analysis that's really significant as well, that sometimes falls by the wayside.
No, that's right.
Richard, I guess I was wondering, how much buy-in do you get with the insurers that you're approaching? Are they very happy to help you with the reports, and is it the same across the board, or?
Yeah, I mean, I think, as a group, they're all very cooperative, and they're all keen to help, because actually it's in their interest at the end of the day that trustees' concerns are allayed, and that they want to make sure that their insurance business is portrayed in the correct light and in a strong light, if you like. So they are quite keen to engage. They have constraints in terms of the information they can provide. They all have December year ends, and they all have sorts of sensitivities around that. And there's commercial sensitivities. Some of them are listed, so they have listing requirements, but by all, to pretty much all of them, they are all very cooperative and helpful and just have regular calls with us. So I think there's an acceptance of this type of analysis in the industry now.
Oh, that's really good to know.
And trustees, if they are contemplating a buy-in transaction and thinking about exactly this, how should they select Argyll or another provider, or how should trustees go about selecting a provider for this type of advice, this type of work?
Yeah, I mean, we would suggest that independence is quite important, because, I mean, there are a number of providers out there offering this sort of service, but we stand outside the broking transaction. We don't have any role in the selection of the insurer beyond
in the broking. Yeah,
exactly. So I think that's quite important. If you try to offer this as part of the broking package, you might find there's a perceived conflict of interest there. Also, in terms of expertise, I think there's an awful lot of public information on insurers. So I think trustees and employers should expect a little more than just a summary of what's in the public domain. I think there should be additional expertise on top. And certainly ourselves, we have our own in-house insurance expertise to be able to deliver our assessments. And I think finally, cost. It doesn't have to be expensive. So, just shop around, make sure you're getting reasonable value for money, because this sort of analysis does not need to be expensive in the context of a transaction.
Yes.
Yeah.
So, sorry, go on, Helen, go on.
No, I was just going to say that's really helpful. And I think, as we said at the start, it's so topical, because even the recently published General Code has a lot of guidance about investment and what trustees should be thinking about. And this can be something that really backs up that the trustees have had given proper consideration to the decision that they're making.
It's a very busy market, and a lot of trustees will be thinking over 2024 and beyond, the opportunities for buying out, possibly only constrained by the capacity of the insurers. So it's going to be an interesting year, I think.
Yeah, absolutely. So, Richard, on that note, if you could leave our listeners with one or perhaps two key messages, please, what would they be?
I think the main thing I would suggest would be to just do some financial due diligence on the insurer. I mean, I think that's crucial. It's a governance process, and it's a one-off opportunity you've got to assess the insurer. So, my one piece of advice would just do some financial due diligence on the insurer.
Yeah, absolutely. Thank you. Well, that's been an absolutely fascinating discussion, and I think that it would be really useful to trustee clients, but as you say, corporates as well, considering their strategy and solution for their DB schemes and risk transfer as part of that. So, Richard, thanks ever so much for coming on our podcast.
Thank you.
Thank you for listening to the Burges Salmon Pensions Pod. This is our last and final episode in season 4.
Helen, I can't believe it. I've really enjoyed doing this season, and it's flown by so fast. But we've covered some great topics, haven't we?
Well, luckily, Chris, that all of the previous episodes will still be on the Burges Salmon website, wherever you listen to your podcasts.
Yeah, that's right. And to all our listeners, thanks so much for listening, and keep your eyes and ears peeled for season 5 later this year.
Bye, everyone.